Hey everyone, me Kevin here. Let's talk about what the heck is going on in the market and what I'm doing about it, because here's the thing. The market is very red, and usually I hold a to the moon coffee mug in my right hand, but now I have to hold a buy the dip coffee mug in my left hand. Folks, let's talk about this. We're going to talk about inflation. We're going to talk about oil. We're going to talk about energy, food. We'll also talk about what I'm doing in terms of my investments, as well as a little update on Evergrande and some of the other madness going on. Okay, folks, let's get into this. So one of the first causes for concern has to do with new reports out of Brazil that we might expect to see substantially more inflation in food prices than ever before. In fact, the UN index on food prices is showing that we are up 33% for a lot of food sources year over year. Brazil in particular got decimated with a horrible drought this year. And then after the horrible drought killed off many plants, we got a crazy Arctic frost that killed off even more. In other words, you had this double whammy of potentially, climate change, destroying crops and leading to massive increases in food pricing and more supply chain disruptions, as you've got vendors around the world looking for new potential exporters for orange juice, soy, ingredients, sugar, coffee, and corn, which are some of Brazilians' biggest exports. In fact, Brazil apparently supplies 75% of our orange juice, 54% of our soy products, 50% of our sugar, 32% of our coffee, 22% of our corn. That's crazy. So, yeah, you're going to see some food prices go up. It's not just food prices, unfortunately. And remember, anytime we hear inflation, the market kind of gets a little freaky, right? So that inflation report out of Brazil, not so good. Now, some, local sources say this is just FUD. Don't worry. We're a big season. We got plenty of, we're a big area for farming. We're a big ag industry. We've got plenty of water. We'll be fine. This is just a one-time event. Whatever. It just happened to happen right after the COVID pandemic, where supply chains are already screwed up. Then you've got this energy crisis going on. In the United Kingdom, for example, can't get enough natural gas, and they can't get enough energy from renewables in the meantime. This means the price of natural gas is skyrocketing as demand is going crazy in the United Kingdom. This has made commodity markets a lot more tenuous and essentially nervous. And at the same time, in the United States, where fortunately we do have a diverse supply of energy sources, we're not so concerned about natural gas prices skyrocketing, but instead we have insanely high oil demand as we're reopening at the same time as we're still recovering and suffering essentially from strained oil production from the Gulf's 2 hurricanes this year that contributed to oil prices going up. So now you've got an energy crisis in the United Kingdom. You've got oil prices going up over here. In fact, if you look at Brent crude oil and you look at the day chart, you'll see that we crossed $80 for the first time in many years that we've crossed $80. In fact, let's go out here to the 10-year and just see when the last time was that we hit $80. So last time we broke $80 was briefly in 2018, just very briefly. But you can see we really haven't been sustained above $80 since about 2014. So $80, this is a pretty big recovery from the bottom of the COVID recession here, where at one point we actually went negative on oil prices. But now we're seeing quite the opposite. And so this is obviously leading to pressure on the 10-year treasury yields and just treasury yields in general. If we look at the 1-month chart for treasury yields, we'll see that we've moved up nicely here on treasury yields, which is usually associated with, if treasury yields are going up, that means inflation fears are going up, and that means the stock market sells off over inflation uncertainty. Now, interestingly, if you go down to the 1-day, we actually peaked around 1.56. We've since pulled back on this this treasury yield, the 10-year treasury yield here. We've also pulled back on this sort of peak crude pricing. And so you'll see this is the day chart. So we're at bottom of crude pricing for the day. We're at bottom of 10-year treasury for the day at the time of this recording. But yet look at this, the Dow Jones Industrial is also at bottom. You would think if Brent was recovering and treasuries were recovering because people were fearful of inflation, that the Dow Jones would be going up again. So it kind of leads some of us to think maybe it's not just inflation that people are fearful of. In fact, if you look at something called the 10-year break-even curve, let's do this. Type in St. Louis Fred 10-year break even. Slap that into Google here, pull it up. Take a look at this. This is fascinating what's happening here. We're going to zoom in to just the last few months over here. So what this chart here is the 10-year break-even inflation rate, and basically takes the 10-year treasury rate, subtracts off TIPS, which are treasury inflation-protected securities, which is basically a way of saying, I'm just going to bottom line this. I'm fast-forwarding a little bit here, okay? The higher this chart goes, the more the market's freaking out about inflation. So the lower it goes, the less the market's freaking out about inflation. Well, it's been flat. So if we're really worried about inflation because of energy costs in the United Kingdom, oil costs in the United States or throughout the world, food costs in Brazil, or, oh no, treasury yields shot up but then came back down, like why isn't the Dow recovering? It's probably because inflation is actually not the real concern that people have right now. Even though Jerome Powell says supply bottlenecks are bigger and longer lasting than expected, and Jerome Powell reiterated that this morning, reiterating again that these inflation expectations are probably temporary, they're just lasting longer. The issues of where we're seeing inflation are in categories where we do expect them to be temporary. We think they'll last a little longer, yes, but we think they'll go away. And honestly, I think the market's starting to believe him. In fact, when we look at these charts, it makes sense. This is actually not a sell-off due to inflation, energy, crude. I personally think all of that is just noise. It's noise, 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 noise. You know what I think is really happening? Folks, it's Evergrande. It's my opinion. There are lots of different opinions going on. People are like, oh, it's the debt ceiling. Oh, it's the budget deficit. Get the United States budget getting extended. Oh, it's going to be, are we going to get the $3.5 trillion package and the tax increases or not? Sure. I think all of this noise can contribute to volatility and uncertainty. I do believe that. But I think the real catalyst here is actually Evergrande. Because listen to this. On October 3rd, which is a Sunday, so really October 4th, $260 million of notes mature against Evergrande from a company called Jumbo Fortune Enterprises. Now, this company holds bonds in Evergrande. One of their owners, which is such a weird loop, is actually also an owner or a subsidiary of Evergrande, which is this like really bizarro lupo. It's a disaster what's going on over there, and the transparency is horrible. But the point is, $260 million of bonds mature, come due on October 3rd, which is a Sunday, so October 4th. And folks, October 4th is like next Monday. It's crazy. This Friday's already October 1st. We're not getting jobs data this week, though. We get jobs data next week, and we get CPI data next week. And, if you thought maybe the market was being tenuous because Jerome Powell and Janet Yellen were talking, maybe they blabbered and we kind of saw the market fall, but it didn't really either recover afterwards. And they didn't say anything, super spectacular. They said a lot about many different things, but if anything, I thought some of the things that Jerome Powell was saying about interest rates were actually potentially bullish. Go watch my video, what Jerome Powell and what Janet Yellen just said. If you haven't seen that yet, go watch it. But what's more important, folks, I think these Evergrande due dates. I'm going to put something on screen here from my iPad. Look at this, okay? These are the Evergrande due dates. Please take a moment and screenshot this, okay? I put this together, from research. I think the source here is Bloomberg for what it's worth. But I put this into a little chart here. It's not really a chart, it's a bubble. It's a circle. Anyway, screenshot this, okay? Evergrande due dates. China Evergrande, March 23rd, $2.03 billion. These are the 2022 due dates. So here, hold on, before you screenshot. And this comes after the remaining catalyst of 2021. So the 2021 catalyst is the 260. So I'm going to put after 260 mil in October or on October 4, 2021. Okay, there. That'll be a little better for you to take a screenshot of. Okay, all right, ready? So take a screenshot of this right here. So you've got Evergrande 2022 due dates after the 260 million due on October 4th, 2021. You have China Evergrande, March 23rd, $2 billion. April 11th, $1.4 billion. Hengda Real Estate, which is owned by Evergrande, and that is for July 8th, 8.2 billion renminbi, which is the Chinese currency, about 1.269 billion USD. So the top two are denominated in USD. That July 8th one's denominated in renminbi. That's why we're changing currencies, since the currencies fluctuate. Scenery Journey, and then you get these others here. 2 billion in October, 645 million in November. Anyway, this company's going to go bankrupt. Like, I don't see this company not going bankrupt. Some people say, oh, it'll get federalized. Some people say, no, their contracts will get distributed to other developers, and then the other developers will get really sweetheart deals and partnerships with local governments. The point is, things just aren't good for Evergrande. I personally think if things get better with Evergrande, the market's going to perform a lot better. And I really believe that inflation is not the sole concern here. When we start trading below the yellow line, which is the 50-day moving average, sometimes we can get continued pain or continued bouts of pain. Not always, but just go ahead and look at this year, for example. Trade below the 50 over here, it kind of signals a little bit of pain to come 2 to 3 weeks later, where we get a bigger dip in February. You get this dip over here, you get these other dips. Now, obviously, dips happen, but look, sometimes you get these dips above the 50-day moving average. It's really not a big deal. It's when you break that 50-day moving average, sometimes it can kind of forecast a bigger dip. See, even a small dip, forecast a bigger dip. Here, you didn't really get that. So it's not foolproof, obviously, but we're trading substantially under the 50-day moving average. And so that's, I think, what's worth noting is that we really haven't traded this substantially below the 50-day since September of last year or October of last year. And those are really good dips to buy in hindsight. And so in my opinion, since we rarely do trade with the S&P 500 under the 50-day moving average, it's a buy the dip opportunity. That's just what I'm a fan of. I'm a big fan of buying this dip. I'm buying my favorites, Enphase, Affirm, Palantir. Now these are tech exposure, fintech exposure, higher valuation, right? Energy exposure, things that, can tend to sell off when there's uncertainty in the markets. But that's great because it creates an opportunity for me. So I'm buying this dip. I would keep an eye on that 50-day moving average for the S&P 500, though I think it's a perfect buy the dip signal for you when you're shopping. But that doesn't necessarily mean the dips are going to get you a better deal than if you bought sort of, at least for the S&P's purposes, on a green day. I mean, sure, look, if you bought on a green day, let's say right here, depending on when you bought within that day, you'd probably be below the biggest dip over here, right? So it just gives you an example. Time in the market beats timing the market generally, right? But I like buying the dips. I like when there's fear buying. I don't see massive fear catalysts outside Evergrande. And the way I'm going to judge that sell-off is by looking at Evergrande stock, 3333.hk, just type that into Google, or 6666.hk, that's the EV division. I'm going to watch those. I'm going to watch the bond payments, I'm going to watch the crypto markets, and I'm going to watch real estate prices in China. That is going to give me sort of a heads up in terms of potential issues here. Now, crypto is falling here today, and that could be why we're also seeing a red market, because that is a warning sign for our market. So in my opinion, this is Evergrande fear. I am not going all in with my cash, but I'm maybe deploying about 7% of the available cash that I have in buying the dip. So just for example, if I have $3 million, I probably deployed about $250,000 today, roughly. That's roughly what I deployed. So just to give you a thought as to where I am. And if we keep dipping throughout the rest of today, I might even buy a little bit more. But I'm bullish on kind of buying this dip because that's kind of what our markets have been really good at, is just buying the dip. All right, folks, thanks for watching, and we'll see you in the next one. Bye.